Welcome to today's webinar on construction conditions. I'm Haley Shenander of the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees. Eric will be entertaining questions at the end of his presentation, so if you have a question, please type it in the chat box on Zoom. We'd also love to get your feedback at the end of this presentation as well, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. And with that, I'm going to turn it over to Eric.
Thank you, Haley. I appreciate that. Thank you, everyone, for being here, and welcome to the Regional Economic Conditions webinar on the construction sector. And my name is Erick Garcia Luna, Regional Outreach Director with the Federal Reserve Bank of Minneapolis. And with that, let's just get started. But first things first, just my disclaimer that the views expressed here are mine and my interpretation of the results of this survey, and not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. Before getting started, a big thank you to all the partners that made this survey possible. For starters, we're always aiming to improve, and our surveys and my conversations and exchanges with you yielded to some, revisions and some improvements in that survey. So thank you for that, and for pointing out what you wanted to learn. That's very helpful to us. After all, you're the ones that are living the economy of the sector day to day. And thanks to those of you who suggested a couple of new questions as well. More importantly, your partnership in distributing and reminding your members about the survey is key to the success of the survey. So thank you again for your time, your commitment, and we look forward to continuing to grow this partnership. Let's talk a little bit about what this survey is. Again, we use a partner model distribution. We partner with about 50 associations from the 9th District. As a reminder for everyone here, the 9th District includes the states of Minnesota, North Dakota, South Dakota, Montana, 26 counties in the northern part of Wisconsin, and the Upper Peninsula of Michigan. We received 252 complete responses, which is about a 93% completion rate, quite a good rate, actually. The survey had 20 questions and covered activities from experience activities from November to April, as well as their expectations for the next 6 months. So we will see some of that throughout this presentation. Key takeaways. Overall, I would categorize as, I noticed a decline in activity across the sector, persistent cost increases, ongoing labor challenges, and a lot of uncertainty about what the near future holds. The geographic concentration of our respondents tilts a little bit heavy towards the Minneapolis-St. Paul region, although we got some good representation relative to other surveys that we've done in the past from North Dakota this time around. So, but Minnesota definitely is well represented in this survey. The results, however, I think can be interpreted as relating to all the different states. Everybody seems to be going through a very similar experience in the economy today. The great majority of respondents operated in non-residential, and revenues for those respondents were mostly above the $2 million mark, with good representation from very large companies. Before we dive into the results, I just want to make sure that we understand what these results, how these results should be interpreted. They're based on a convenience sample to gather commentary and sentiment on economic conditions of the industry. That's mainly how I would encourage you to interpret this presentation. The metrics that we'll be seeing, that we'll be discussing, compare again changes between November of 2024 and April of 2025 to the same period a year ago. That would be November 2023 through April of 2024. And we also, again, asked companies to tell us what their expectations based on their individual experiences today are for the coming months. So again, interpret this with caution. Results are specific to the 252 companies we heard from and not necessarily representative of the sector as a whole. And on to the results. How have the last 6 months been for the construction firms that responded to our survey? When we asked our respondents about their experiences over the most recent season, a little over half of them reported a decline in activity. That's 52%. This is when compared to the same period last year. It is a significant drop, and it really highlights some of the challenges the sector may actually be facing right now. Not all is doom and gloom. For about a quarter of respondents, things have actually improved. You can see this represented in the green and navy blue sections of this chart. These firms have seen better activity levels compared to last year, which is definitely a positive sign. And then we have similar share of respondents shown in yellow who said that their activity levels were pretty much the same as last year. So while there are certain challenges, there are also some pockets of stability and even growth within the construction sector of the region. Let's take a closer look at where these changes are showing the most. Over the last 6 months, there has been some shifts across various elements in the construction sector. The arrows on the right side of the slide illustrate the share of respondents who experience declines in each of those elements. First off, we have project backlogs. A notable 58% of respondents reported a decline in their project backlogs. This is quite telling as it may indicate that many firms will be struggling to maintain a steady flow of projects. Interestingly, several comments from the survey highlight a strong ability to complete projects. This is perhaps reflected in the 60% of respondents who indicated that they had a higher or steady volume of completed projects. That is a positive sign when companies can work through their backlog as it brings in revenue and allows them to move on to other projects. However, the downside is that this backlog isn't being replenished with new projects, or at least that's the sense we got from some of these results. Um, this is where the concern lies when we look at the data that the survey produced. 47% of respondents noted a decline in submitted RFPs, requests for proposals for private projects, and 42% reported a decline in submitted RFPs for public projects. This suggests, among other things, that bidding might be becoming increasingly difficult. On one hand, many firms pointed to a reduction in the number of projects being put out for bid. These projects are either being paused or canceled, which limits the opportunities available. On the other hand, firms are finding it challenging to submit bids due to the uncertainty in pricing. This uncertainty makes it difficult to provide, accurate, competitive bids, and just makes it challenging for companies overall. It's also worth noting that the share of respondents reporting decreases across all of these metrics was actually higher than in 2024. Back then, things were challenging, but there was a sense of optimism. And so the share of respondents at that time that reported declines in all of these metrics was lower than what you're seeing in front of you today. To summarize some of the most prevalent comments that came up regarding backlogs and what is affecting them. Again, there's a wait and see approach from clients who were hoping for lower interest rates, perhaps at the end of 2024, moderating prices in 2025, completion of projects, again, not slower scheduling of new projects, lower but definitely persistent cost increases both in inputs and in labor inputs and non-labor inputs, added uncertainty from trade policy, bidding difficulties, and increased pauses on projects. Some of that sentiment is reflected in the available hard data that is out there. This chart is put together with data from Dutch Data and Analytics. When we look at the holdup on projects that respondents have alluded to, we can see a clear pattern emerging in 2024. There was a sense of optimism and hope for lower rates. This optimism was driving activity in the sector as firms had anticipated also better conditions ahead. However, as we move into 2025 in this chart, the picture starts to change. The activity that was once sustained by that optimism now appears to be flattening, even slightly decreasing. Again, this shift could be indicative of the challenges and uncertainties that the sector is facing. Firms are becoming more cautious. Higher costs have continued to put pressure on construction firms, and this is coming from both labor and non-labor input costs. The majority of respondents reported higher costs across the board, which is quite concerning. More notably, increases in prices for materials and wages for specialty workers. Some of the materials that were highlighted include steel, concrete, aluminum, some components, pre-manufactured components. These are essential materials for construction, and the rising costs, are having a visible impact on the industry. Additionally, there were comments about having to pay more for shipping. This adds another layer of costs that firms, have to manage in addition to what we have already discussed. However, it's important to note that the share of respondents reporting increases the intensity of those increases is comparatively lower than in 2024 and 2023 spring surveys. And what do I mean by the intensity? In the past years, more respondents were reporting increases about 5%. Those are the blue, orange, and barely noticeable gray areas in the chart. Those were relatively larger in those surveys. While costs are still rising, the rate of increase has slowed down a bit compared to previous years. This is a small, silver lining, but it doesn't change the fact that higher costs are still a challenge for a lot of the construction firms that are in the district. Now, let's take that last chart and compare it to the changes in prices that respondents charge to consumers. When we put these two side by side, it becomes clear why even with lower cost increases, they can still feel quite significant. A relatively lower share of respondents reported increasing their final costs compared to those reported input cost increases. Those prices charged to customers, the chart on the right and the chart that we discussed earlier on the left. This discrepancy, just highlights the ability to pass on costs to consumers may be limited. And as a result, profit margins are likely also getting squeezed. In other words, while firms are facing higher input costs, they aren't always able to raise their prices accordingly. This creates a challenging situation where many companies have to absorb those additional costs, which can put significant pressure on their profit margins. Those experiences with higher costs seem to be in line with what the published data tells us. According to the Producer Price Index for inputs to new construction, this is somewhat of an inflation indicator, if you want, which measures the increases in prices in the goods and services used in construction. The year-over-year change in prices has definitely decelerated in the last year or so. Well, what do I mean by that? Well, prices for goods and services used in construction are still increasing. That doesn't mean they've stopped increasing or that they are actually decreasing. But again, the rate at which they are increasing, they're not compared to those seen in 2021 and 2022. And while costs are still rising, again, that pace has slowed down significantly. Now, what about labor costs? This is, another area to consider. And for that, let's quickly look at the average hourly earnings from the Bureau of Labor Statistics. When we take a quick look at these trends, two things immediately pop up to me. First, there is some variation in wages across the states in the district, depending on where you are. These are wages, average hourly earnings, I'm sorry, for the construction sector in the states across the district. Um, Again, the first thing is the variation across those different states. Second, wages accelerated through 2022 and 2023 across all states. For many firms, raising wages was part of a strategy to attract workers. This was especially important during a time when finding those skilled workers was yet a more significant challenge. And now, while the rate of increase has decelerated in those earnings, they're still going up in the face of persistent labor trends. Firms are continuing to adjust the wages they pay to attract and retain necessary talent, which is crucial for maintaining their operations and meeting project demands. We ask respondents to tell us about their challenges in their operations. This time we asked, respondents two questions to identify both the top challenge and the second biggest challenge to their business operations. Um, and, in each case, they were only able to select one option. This approach kind of allows us to separate the counts and the intensity of each of those challenges. And as you can see in this chart, almost a third of respondents selected government policies and regulations as the number one challenge. This is mostly attributable, if I go through the comments, mostly attributable to the uncertainty from trade policy. Business relies heavily on planning, and the construction sector is particularly susceptible to any disruptions in that planning. Just to quote one respondent, and I quote, volatility in the overall economy makes it hard to forecast and plan. Um, and so just taking that quote into account, it makes sense that respondents will feel strongly about government regulations. Competition for available projects came in second, but it was the challenge with the most counts. In fact, 41% of respondents said it was either their number one or their number two challenge. I added the second challenge on the right, just added the percentages for each of the categories. Um, a variety of elements play into these. There are reduced numbers of projects out for bid, increased pricing that challenges the competitiveness when bidding, and the other one, customers not accepting rising costs, among many other factors. Last but not least, and I will only mention it here very briefly as I'll go into more detail shortly, is labor availability. For over a quarter of respondents, labor availability remained a stubborn challenge. Now, how are those three challenges manifesting? Again, I mentioned some of these already, but uncertainty around tariffs is slowing down bidding. Some comments made reference to federal grants and other policies affecting agreements and funding. Again, pausing projects. They were already being paused with hopes that things will improve this year, but more are being paused. That's leading to heightened competition. Higher material lead times was another. Um, Projects being awarded at lower margins. This is also due to rising prices, inability to secure talent, which also can reduce capacity and affect competitiveness. And with that, we transition into labor demand in the construction sector, which actually remains solid. About 60% of firms were hiring. More than half, that 60% were hiring for either full-time, part-time workers, or we're taking some steps to where we're hiring to mitigate turnover. This is a positive sign, showing that there's still a healthy demand for labor in the industry. However, it's worth noting that this is a smaller share than in previous years. While demand is still there, it's not as robust as it once was. This could be due to a variety of factors, including the challenges we have discussed throughout this presentation, such as higher costs and uncertainty in the market. There were some slight improvements in the ability to find needed talent as the labor market has cooled a little bit. For an almost equal share of respondents, this ability the ability to find talent was either better or worse. Those orange and light blue bars showing the much better the share that told us their ability to secure talent was much better than a year ago, and in the green and navy blue, much more. So those shares are pretty much comparable. In years past, the balance has actually tilted a little more heavily towards the worst side. So you will see those green and navy blue bars being higher. So this is a bit of a positive shift in terms of being able to secure the workers that are needed. For almost half of respondents, that ability to hire remained unchanged. But I will note that in some cases, this meant they were still struggling to hire. So it hasn't changed. Nothing has improved. They're coming from a time when, when it was very hard to secure the labor that they needed. One respondent put it as about the same equals bad, and that stuck to me as I was looking through how to through the data and trying to interpret these results. So I will, I will say that, overall there are still some challenges to find workers. On the flip side, in other areas, companies are receiving more applications, so it's a bit of a mixed bag. But again, I think it's safe that broadly speaking, um, it's safe to say that struggles to secure talent remain. While there are some improvements, there are challenges in finding the right talent. That was also very prevalent in the comments, and so those challenges are still very much present. Now, when taking a look at the data from the Bureau of Labor Statistics, we can see that employment in the construction industry has been growing at a steady pace over the last few years across the district. However, if we examine that trend a little more closely, the slope appears to be, somewhat flat. This flatness, highlights some of those challenges the industry has been facing when it comes to adding workers to their payrolls. Same data, but in this chart, I'm taking January 2019 as our starting point to see how employment in the construction industry has changed since before the pandemic. It's quite interesting to see the variations across different states in our district. First, I will point to South Dakota, which stands out with a remarkable 30% growth in construction employment since 2019. That is a healthy increase and shows, a strong upward trend in the state. On the other hand, you have North Dakota, which has relatively, recently recovered its construction employment levels to what they were before the pandemic, achieving this about a year ago in, 2024. When we look at Minnesota and Wisconsin, we see steady but slow growth in construction employment. And while Montana's construction employment appears to be actually, somewhat declining. Now, we got a lot of comments from our respondents on trade policy, so I will be remiss if I didn't take a moment to briefly touch on that. Perhaps not surprisingly, for about 3/4 of our respondents, material costs are being negatively affected by tariffs, or even just the talk of tariffs. This is a significant concern for many respondents. Almost half of the respondents mentioned that the number of projects available for bid and their backlogs were being affected. We've already covered some of those dynamics as well, but it's worth reiterating how impactful, this can be. The sentiment from that respondent who said earlier, I quoted earlier saying volatility in the overall economy makes it hard to forecast and plan is echoed here. and by many in the industry who are finding it challenging to navigate uncertainty. And so what's ahead in the next 6 months for the respondents to that for those that responded to our survey? For the coming 6 months, they are expecting more declines across the board. You can see that here in all metrics, project backlog, operating revenue, et cetera, et cetera. And it's for many of the same reasons we have already discussed. Interest rates, prices are increasing, and the added uncertainty. Without some more certainty, many companies seem to, will say that they're finding it difficult to plan and execute their projects effectively. Again, a little bit of a mixed bag when you see those green bars as well. Some are expecting um, higher levels of activity throughout these metrics. But overall, it's safe to say that this is tilting a little bit on the negative side, particularly as we also take a look at those that said mostly unchanged. That mostly unchanged relates to the conditions today, which as we already saw, have been tilted, slightly negative, tilting slightly negative. For the coming 6 months, respondents expected input costs to increase at a similar pace as they have in the past 6 months. However, it's worth noting that a larger share of respondents expect prices from vendors to increase between 5 and 9%. So there's a little bit of an increase in that bracket compared to those who experienced that level of increase in the last 6 months. Most respondents also plan to raise their final prices, with the expected increases being in line with the observed increases over the past 6 months. This indicates perhaps that firms are anticipated um, continued cost pressures and are preparing to adjust their pricing accordingly. One interesting point is that a smaller share of respondents expect to raise wages compared to those who observed higher wages in the last 6 months. Maybe there's an expectation for, more workers being available, et cetera, et cetera. Now, the industry in the district, we asked individuals how they felt at the beginning of the year, and if those expectations that they have today had changed compared to how they felt coming into 2024. And I will just say the industry in the district was showing some signs of optimism going into 2024. You've heard me mention that a couple of times. The story that the data and the commentary from this survey tells us goes something like this. Price increases were moderating. There were expectations for changes in interest rates. Combined, those dynamics will potentially encourage mobility in the residential market, increase investment in other projects. However, instead of those anticipated improvements, there has been some added uncertainty, that has caused almost 3/4 of our respondents, as you can see in this graph, in the orange and light blue bars, there has been 3/4 of those respondents who feel more pessimistic about their outlook for the next 6 months compared to how they felt at the beginning of the year. Amid all of these, there are still hopes that a steady direction will be given, allowing some planning to resume and hopefully some stability. And that brings us to the end of this presentation. I hope you found it useful. Thank you again for being here. And the last thing I'm going to do before Haley comes back on, I will ask that you consider becoming a regular informant of our work. We regularly go to businesses for input. We execute surveys. We do roundtables. And we have one particular product that we do regularly, that is our business pulse survey. So if you're a business that wants to help inform the work of the Fed, please consider signing up. Scan this QR code. It will take you a minute or so to complete that quick survey and tell us how to contact you, et cetera, et cetera. And then we'll reach out to you, not all the time. This is a monthly survey, but we'll try to reach out to you. We'll reach out to you for your insights. So consider helping us be informed. And again, thank you. I'm going to leave this screen there for those of you that might need more time to think about it. Thanks.
Great. So we're running a little over time, but we can still take a couple questions right now. As a reminder to everyone, if you have questions, please type them in the chat box on Zoom. So how about we start with this one? Tariffs have been off and on. Why would they be affecting material prices if they're put on hold?
That is a great question. So one of the things that I noted in the comments and that we have actually heard as we talk to other businesses is that, is that some companies were already raising prices in anticipation to kind of mitigate some of the burden from tariffs. So how prevalent is that? I'm not the one to say. I don't have the data with me, but I think from the comments and from what we've heard is that even when tariffs were not implemented, there were already some surcharges being added to material costs, and some vendors were raising their prices perhaps in anticipation for having to pay higher tariffs in the future.
Got it. And then someone else was wondering, are interest rates still a challenge for construction firms?
Yes, and as a matter of fact, you didn't see it in the chart of top three challenges. I neglected to point out that those challenges were the ones that got more than 10% of respondents saying that it was their biggest challenge. About 8% of respondents uh, still highlighted that is a challenge it's a top challenge, I should say. It is still a challenge, but again, what I focus here is what people consider to be the most intense challenge to their operations.
For sure. Great. Thanks. It looks like we have time for just one more question here. So, someone was wondering, are changes in immigration policy affecting construction businesses in the region?
Oh, that's a good question. So, curiously enough, I did not get many comments on immigration. I can tell you from conversations on the side that I'm hearing that workers are still showing up to work, right? Like there are decisions that people have to make in terms of you know they still have to eat, they still have to pay rent, so they're still showing up to work. So I'm left to wonder whether that some of that sentiment is also being seen in the lack of comments regarding immigration. I kind of expected to see some of that in some of those comments pop in the labor section of the survey, but I did not. I was actually myself a little bit surprised that didn't show.
Right. Well, that's all we got time for today. As a reminder, everyone, more information will be in a follow-up email to this event. And thank you all so much for joining us today.
Thank you.